Welcome, everybody, to the 21st episode of the Hashtag Invest This podcast. Today, we have the one and only Scott Garner here. How you doing today, Scott?
I'm doing fantastic. How are you, Scott?
I'm also doing well. Scott is a tax guru, I'm going to go ahead and say, and full transparency, I work with him, so I'm happy to have him on the show. But why don't you give the listeners a little bit more about your background, where you come from, how you got to where you're at now, and kind of what you're focused on now?
Sure thing. Thanks, Scott. Well, I'm originally from the state of Idaho, and I currently reside in Arizona. While living in Idaho, long before I was a tax professional, I bought myself a farm. It was 12 acres, and I did not know what the heck to do with it. Come to find out, I had to file a tax return specific to farms. It's called the Schedule F. And I could not find a single person I felt confident doing tax returns. I'm sure we've all been in the same boat. We pursue a tax preparation expert, and we get an uneasy, a queasy feeling about their abilities, and I chose not to use any of them. So this is back in the year 1996, long before anybody had internet or even cell phones. And believe it or not, I spent over 80 hours in 1 week at the library figuring out how to do my own taxes. And that's how I got my start. Come to find out, there's all kinds of stuff in the tax code that nobody's aware of. And believe it or not, just about every week, if not every day, I learned something myself. So there you go. It's complex.
And this is something that you do, every single day. Obviously, we've had tons of conversations, but this is something that you've been doing since 96, probably every day.
Right. I'm what's called an enrolled agent. An enrolled agent is the only license that the IRS hands out. You pass a test, you have to sit for the license, similar to a CPA or an attorney would sit for theirs. And it's a 3-part test given out over 3 days, over 3 different variety of topics. And you pass the test, you get your license from the IRS. You got to take your continuing education of minimum of 24 to 30 credits per year, maintain your license, and you can do anything representing any client before the IRS unless they are wearing guns. And then I don't want anything to do with them.
So, this is a real estate investing podcast where everybody out there, the listeners, are primarily going to be real estate investors. So why would a real estate investor want to come to an EA like yourself compared to having their typical CPA or even attorney prepare their taxes for them? What might be the difference?
Sure, you bet. Attorneys are expensive. I used to work for one, so I know they're expensive. CPAs are less so. The problem with attorneys and CPAs, in my experience, is not all of them know how to do taxes. Now, anybody can go out and buy tax preparation software. You can go out and buy TurboTax, right?
Mm-hmm.
Is it going to do as good of a job as a tax professional? That depends on how complex your tax return, your situation is. I always like to see what I'm dealing with before I give somebody a quote. That's my most common question on the phone. How much for you to do my taxes? I don't know. I got to see what you got going on first. How many rental properties do you have? How many houses did you flip last year? That all has an impact on what I'm going to charge you. So some CPAs might be nothing more than bookkeepers. The bookkeeper doesn't necessarily know how to do a like-kind exchange. So an attorney, oh man, there's a lot of attorneys charging big fees and not doing anything once they have your money.
So would you say that a common misconception, because I think that this is probably the honest truth, the common misconception is that if somebody goes to an attorney to prepare the taxes or they go to a CPA to prepare the taxes, they're guessing that CPA or taxes knows what they're doing, right?
They are. They need to verify that person, that tax preparation expert, actually knows what they're doing. And a lot of attorneys and CPAs are very convincing. And like I said, that tax preparation software makes you look like you really know what you're doing.
Mm-hmm.
But there are some poignant questions that you can ask that will weed out, so to speak, somebody that knows what they're doing versus somebody that doesn't.
Now, can you give just a couple of examples of a couple of those questions that somebody might want to ask when they're finding somebody?
Oh, sure. Yeah. This would be the hard part for people to know what to say. It's kind of
Exactly.
like walking onto a car dealer's lot and knowing what cost is before you start the negotiation process.
Yeah.
So, yeah, for like a realtor that's got some rental properties, difference between losses for a real estate professional versus the average Joe Blow that's got a rental house or two and a W-2 wage. What can I do with my suspended losses? When can I take my suspended losses if I have not been able to in the past? So, for example, let's say you bought a rental property last year in 2017, and then you quit your job. You worked for McDonald's, you quit your W-2 job, and you say you're going to pursue real estate full time and you're going to become a real estate professional in 2018. Most rental properties actually run at a loss. So depending on what your income was, you may have had to suspend those losses in 17, and then you get to take all of them in 18. But my question is, what about the suspended losses? Can you take them in 18 that were suspended in 17 or not? The answer is no. You don't get to take those suspended losses until you dispose of that rental property or any one of a number of your other rental properties. Then you get to actualize the loss.
So, I mean, and that's a good example because most people would have no idea what a suspended loss would even be. I mean, when you say that to the lay person, they're like, what?
Right.
What? Even people that are professionals out there that have maybe been renting rental properties for a long time or flipping 100 houses a year may not know what that is for whatever reason, right? So, that is one example, and I appreciate you sharing that. What else do you have?
Another end of the spectrum would be somebody that is an established real estate professional. They have an S corporation. And the question is, what do you do with your rental properties versus your flips? Okay. As a tax professional, I'm going to advise you every single time you buy a house for a flip, you can contribute it to the S corporation. I got no problem with that. But if you're out there buying a half dozen rental properties, there is no way I'm okay with you contributing those properties to your S corporation. Here's the reason why. Assets for an S corporation have to be reported as income when you pull them out of the S corporation. So let's say you've got 2 rental properties in your S corporation. You're going to retire as a realtor, and you want to convert one of those properties to a personal residence. So you kick the renters out, you move into it. Guess what? It's a taxable event. Not only do you have to pay tax on the capital gain, which is the difference between what fair market value is at the time you converted it over the amount you paid for it, you've got to recapture the depreciation, which is mandatory. So the IRS requires when you're renting a property that you depreciate it out over 27 and a half years. And so if you've rented that thing for the last 5 to 10 years, you could have tens of thousands of dollars worth of depreciation that just ruins your basis in that investment property. And all of a sudden, you're looking at capital gains of $40,000 to $50,000.
So, I mean, these are really, 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 really important things, right? When it comes to figuring out your taxes and making sure, because I mean, at the end of the day, one thing you and I have talked about quite a bit is that I never want to be in hot water when it comes to the IRS, ever. I mean, that's the last people who I want to go and battle with ever, because ultimately they're going to win. And I just want to make sure I'm staying above board all the time. And as every other investor out there, including myself, as business gets a little bit more difficult, or you add more rental properties, or you're flipping, or you own more doors, or you're buying apartment buildings, or you're doing whatever it is, the last thing you want to do is at the end of the year owe the IRS a ton of money. At least that's how I feel. So could you give any major advice to somebody, I guess, other than what you just said? What about somebody that already has a CPA that they've been working with for a couple of years? How do they check those people and make sure they know what they're doing?
Well, there's no rule out there saying that you can't, if you have any suspicions, you can take your tax returns and have them examined. by a different CPA. Now, a lot of the CPAs that I know of will charge money for that. An attorney will charge you money just to review your tax return. But we all run checks and balances on each other. And I frequently get a tax return. It usually happens in a prior year. Somebody comes and sees me, wants to use me for tax preparation purposes. And when I'm done with the current year that they brought to me, I ask to see their prior year's return. And I will, in essence, audit it. I'll look it over and see if I would have done anything different. If it's negligible, I'll tell you so, and I'm not going to charge you any money. Many CPAs and attorneys will charge you money to review the return and give you their estimation of what they would have done different.
Now, but you would say that's probably good. I mean, that's good money well spent, right? Because if they find something, yes, you can go back 3 years. Is that correct?
Yes, for a refund. Okay. You can go back indefinitely if you've never filed a tax return. If you owe the IRS from 2008, you can still file that tax return. If you are due a refund, you can still file the tax return. You're just not getting the refund. There's a statute of limitations, so to speak, on refunds. The IRS is not required to issue you a refund if it's any more than 3 years past the due date of the original tax return.
Definitely. Okay. Now, I kind of want to shift gears a little bit here because there's another important thing to think about when it comes to tax preparation. And that's kind of not just tax preparation, but your having your financial advisor or somebody else like that for you that's basically running your estate or handling all your investments other than real estate or, whatever else you got. So tell the listeners how you work with somebody like that to make sure that you as the investor or you as the person is, making the best decisions. How would you work with somebody's financial advisor or something like that?
Sure. I work with a variety of certified financial planners, so to speak. It's a learning experience. It's a joy. And I find that there's a gray area between their knowledge and my knowledge that overlaps. And it's interesting to get their perspective from an investment point of view versus my perspective as a tax guy. I always remind my clients, I'm rather narrowly focused. There's a lot of things I don't take into consideration. For example, can you live off the amount of money that I recommend you pay yourself? That's up to you. That's a conversation you need to have with yourself or with your family. But when it comes to taxes, my focus is to concentrate on allowing you to pay the least amount of taxes out there. So I'm going to look at things from an angle that is strictly interpreted as how much is this going to cost you in a tax liability? So, for example, a self-employed person, somebody with an S corporation, somebody with a partnership, they may be looking to sock away money into a retirement account. And there's lots of things out there. There's IRAs, there's SEPs, there's 401ks, and we're going to look at a lot of different things that will help you to decide which is the best direction for you to take as the owner of those assets.
Mm-hmm. So, and I mean, it's just imperative to have that matchup because when looking at your tax liability and looking at all the investments maybe that you have to look and see what the benefit or what the negatives could be with all of those together. So you and I this year, I think that this is our first full year working with each other, and the tax, it's just day and night difference from working with the guy I used to work with compared to working with you. It's made a big difference. So I recommend all my listeners out there that are listening to this now, spend the money to find out a little bit more about your tax preparer or who is, who you're working with. Because I think this is a pretty important piece of the business and of your life. I mean, think about, there's two things that are for sure in life, and it's death and it's taxes, right? And so we want to make sure our taxes are at least done correctly.
Can I point out one thing, a real focal point that the IRS is going to look at as far as realtors go? There's a cutoff point between where they really are picky about your tax return and they let a lot of things slide. And that figure is $250,000 or $1 million in assets. So if you're a realtor and you're starting to push that $250,000 annual income figure, you better find a really good tax preparation guide, because at that point, the entire tax return is important. Up until that point, Schedule L, the balance sheet, Schedule M1, M2, they're not important. They don't even need to be submitted to the IRS. After that point, they are required to be submitted, and the IRS knows what they're doing when they look at them. I was going to say something else, but I can't forget what it was.
Well, that's really important though that you pointed that out, because 250,000 in gross revenue, is that right?
And $1 million in total assets. So you may have a partnership instead of an S corporation, and you may have as little as 5 or 6 houses. All of a sudden, you're coming up on that $1 million asset figure, and there again, you've got to start, because again, rental properties commonly do not report a profit. They actually operate at a loss. So you're not going to get near that $250,000 annual income figure. Mm-hmm. But if your total assets, let's say each house is worth $250,000 to $300,000 and you've got 5 of them, okay, all of a sudden you're required to complete Schedule L and M1 and M2.
So, and you had mentioned, it probably was just how you said it, but you were mentioning realtors. Now it could be investors. It doesn't matter who it is. Yeah. And is there a difference that you see between a, PLLC or professional limited liability company that a realtor might have compared to an investor that has, several companies or several LLCs that is running all their properties, or, anything like that?
Well, that's a common preaching tool used by attorneys, is to put a property in a separate LLC. And there's benefits to that. There's bad points to it too. You got to pay to have somebody do a tax return for every single one of those LLCs if you put one in each LLC. But yeah, that's you got to take all of that into consideration.
And once again, that's a very important piece of information right there, because before, I thought that every property needed to have its own LLC for protection against whoever the tenants are or whatever. But really, you're just limited to whoever's in whatever properties are in that one LLC. And so, and not only that, but you have to file a tax return for every LLC that you have. So if you have 100 properties, you're going to file 100 LLCs, or 100 tax returns. I don't think you want to do that from an expense standpoint.
And nor is it wise to put all 100 properties into one LLC. So you got to find a happy medium there.
Definitely. Did your light turn off there? There you go.
Automatic lights. Yep.
Well, that's a really good segue, I think, into kind of our lightning round at the end of the call. I really appreciate you sharing all that information. But if I had to ask you one thing, what is your hashtag Invest This tip to keep our listeners moving forward?
Tax avoidance is legal. Tax evasion isn't.
Okay, so I think that's a given, but elaborate on that a little bit.
Just because you're paying less taxes than your partner does not mean you're doing anything illegal. Once again, it's just wise to shop around and get a different perspective on what your actual tax liability is.
Yeah, that's huge.
Let me point this out. A lot of people think that if they do get a little aggressive on their tax return and the IRS calls them up and starts asking questions, they think they're in trouble. They think they're going to show up at their front door and haul them off to jail. That's not going to happen. If you get a letter from the IRS, or if you get audited by the IRS, you are not going to jail. And the worst case scenario is you'll have to pay some fines, you'll have to pay some penalties and some interest, and you'll have to pay tax on the deduction that you took. But that's all there is to it. A lot of people are very comfortable being aggressive on the tax return. As long as you substantiate your position, you've got nothing to worry about.
That's huge. I know a ton of people, including myself, for a long time was like, I don't want to get audited. I don't want to, be called by the IRS, but I don't think that that's that big of a deal. So I appreciate that. And to follow up on your point, it's not about how much money you make. It's about how much money you keep.
Yep. So exactly.
Do you have a favorite book? Book that has had a big impact on you?
Fiction would be The Hobbit, but nonfiction would be The Life of Pi.
The Life of Pi. And elaborate on that a little bit. How has that book influenced you?
One of the things that I live by is to treat others the way that I want to be treated. And I see this with the IRS. I see my peers, other enrolled agents, CPAs, what have you, they call up the IRS and they have an attitude. My philosophy is you attract a lot more bees with honey than you do with vinegar. So I'm always very cordial, but I'm also very firm in my position when I talk to them. And I get a lot further. I'm sure you experience the same in your profession. But learning to work with others, whether they be tigers or people,
is the important part. So
yes.
Thank you for sharing that. Have you had mentors over the years, or have you, had somebody that has really impacted you and given you really good advice? And what has that impact been?
I would have to say that's my father. My father is 75 years old. He is still an active enrolled agent here in Gilbert. Believe it or not, I go over to his house every Sunday for Sunday dinner, and we talk about taxes over dinner.
That's awesome. That's awesome. I mean, that's, you don't hate your job at all. It's what you love to do. I mean, you're going to talk with your dad at Sunday dinner about taxes. So that's huge. That is awesome. Do you have a way to give back? How do you like to give back? I mean, give it to me. Let me know.
The very first year I did taxes for a living, where I got paid to actually prepare tax returns. I had a young lady come in and see me, and she was trembling. She was scared to death. She handed me her W-2s, and I'm just sitting there doing her taxes. And when all was said and done, it didn't take me more than 15 minutes to do her tax return. I told her, "You are getting a $7,000 refund." And she broke down in tears right there at my desk. So my satisfaction, I give back when people come to me with their problems. They've been told erroneous information, and they have proceeded with that information with good intentions and the best of will, and they find out it was wrong. I love to correct a situation that they have been going through. I don't always charge fees for my services. It's very rewarding to change somebody's life. I have $30,000 in collections from the IRS. I'm in an installment agreement. I can't afford to make my car payment because I got to make my installment agreement with the IRS. I get them CNC'd. They don't have to worry about it. The next 10 years goes by and the debt's gone. They don't owe the IRS anymore. I love situations like that.
That's got to be rewarding. I mean, that has to be very rewarding. So, hats off for doing that. And I think probably just doing your service, doing what you do as a tax preparer. Taxes is something that can be very, very scary for a lot of people. And so when you do it correctly and you get them out of hot water, or you do it the right way, they probably are very grateful. And I'm sure that, you feel the same way. So, that's a great last question opportunity here. How can we get in touch with you? How can the listeners reach out to you if they have tax questions or if they have strategy issues that they want to talk over? How can they reach you?
Well, wise or unwise as it may be, I put my personal cell phone number on my business card. You tell me, is that a good idea? So far, I have not regretted it. But I do that. My email address is scott@clecpa.com. And my personal cell phone number is 480-356-2842. Or they can reach me here at the offices of Craig L. Elgren, CPA, PC, at area code 480-464-0205.
Well, hey, yeah, I mean, I have my personal cell phone on all my stuff as well, because at the
You
end of the
do?
day, if somebody, I do, yep, because if somebody's going to reach you, they're going to reach you. In today's technology world, it doesn't really matter. You shouldn't. I'm from a mind of abundance, so I like to give out my information, but I'm pretty sure that you're going to have some people call you, because you've been fantastic for me. And I'm excited that you're on the show today and shared, all the information about being an EA and what that kind of means, and kind of your journey and what you do to help entrepreneurs and other investors and just general people with making sure their taxes are done correctly. So thanks for being here, Scott. And we'll talk to you real soon.
Thank you, Scott. It's been a pleasure. I appreciate it.
You're very welcome. Talk later. Bye-bye.
See ya.